2.2, Current Assets. This video will explore the balance sheet. This video will explore the balance sheet section that is dedicated to current assets. So if you want to know more, just stick around. When we discussed the balance sheet, we talked about assets in terms of short-term, long-term, tangible, intangible, and things like liquidity. Today we go into assets in more detail. What are they and how journal entries are made to record their acquisition or disposition. At their acquisition, assets get recorded at cost, so we must have a way to value those assets. We could value them using a transaction price or use a market for an asset to estimate an external price or some other method. Cash is the easiest current asset to value because we take it at face value. Cash is also the easiest account to understand in all of accounting. This account is the value of either the cash or money market balances or physical bills, including petty cash or cash-like instruments that are very liquid, such as commercial paper. The next current asset is receivables. When a customer buys something with terms to pay us in a certain number of days, we add the amount to the account's receivable account to reflect the increase due from our customers. The journal entry to record a sale transaction includes two parts. The first records the sale, and the second records what happens to our inventory. In the first, we debit accounts receivable because debiting an asset increases it for the amount that the customer has promised to pay, and credit sales to recognize the revenue. But sometimes customers don't pay. How do we handle that? We must adjust accounts receivable to consider debts that we think might not get paid by our customers. We can calculate the allowance for doubtful accounts either by estimating the percentage of sales that won't be paid or by considering the age of the receivables. For example, we can either assume 2% of sales will be uncollectible or that anything over 150 days past due will not be collected. In either case, once you have determined that an account is not likely to be collected, you can write off that receivable by crediting it. You then debit against the allowance, such as You then debit against the allowance. As such, accounts receivable is always stated net of the allowance for bad debts. The next type of current asset is inventory. If a company simply buys and sells merchandise without manufacturing anything, they will only have a merchandise account in inventory. However, manufacturing companies will have three sub-accounts in inventory, which are raw materials, work in process or WIP, and finished goods inventory. Raw materials are where we store the value of our materials that are waiting to be used by the company. Often these are sitting in a warehouse somewhere. They can include both direct and indirect materials. Direct materials leave as a part of the finished product. Indirect materials are the materials needed to support production, but that do not leave as part of the finished product. Indirect materials typically include things like safety equipment, maintenance and repair equipment, or spare parts, or in some cases, things like office supplies. Raw materials should be recorded at cost. WIP, or work in process account, is where we keep the value of the inventory that is currently undergoing transformation. It is the product that is still in production. WIP gets valued differently than raw materials. WIP needs to include the value of the direct materials used to produce the item, plus the value of the labor and overhead required to transform the parts into their final state. Once we're finished with working on the product, we move it out of the WIP account and into finished goods inventory. The inventory in the finished goods account is ready to sell. When we make a sale, we complete two journal entries, one to record the revenue, as we saw earlier, and the receivables, and the second entry moves the value of what was sold out of finished goods inventory and into the cost of goods sold account. These journal entries move the cost from the balance sheet to the income statement, effectively converting the cost into an expense. Keep in mind that we do this when we sell the item, which satisfies the revenue recognition criteria and the matching principle. After inventory, the next current asset is prepaid expenses. These represent any type of expense that we have paid for but not yet consumed. This type of expense usually relates to things like rent or insurance premiums, but it could technically also relate to product that had to be paid for before it was produced, like a special order. In that example, we haven't yet received the inventory, so we can't put the debit into inventory, but we could debit a prepaid account to offset the cash that we credited when we sent the money to the vendor. All current assets share one thing in common. They all consume cash in one way or another. For example, if you extend credit to a customer, when you sell something, you need to have enough extra cash to make it until the customer pays their debt. That is because when you have to pay for the materials that you purchased and the customer hasn't paid you, you'll need cash to pay your vendor. That requires you to raise extra capital. I'll bring this up again in a few weeks when we start talking about sources and uses of funds. For now, think about how you would fund each type of current asset.